in the near future. So let's get right into the definition of a bridge loan. So a bridge loan is a short-term loan. It's only for about a year, and it's used to pull cash out from a home and use that from the departing residents, use that cash out to put the down payment on the new home and that they intend to buy. The true bridge loan will not count the payments that you have on that mortgage that you just pulled that money out. So your existing home, there's a mortgage on that. You're pulling the cash out of that. A true bridge loan will not count that debt against you when buying the new home. That's what a true bridge loan does. So there's a lot of other ways of doing it, but a true bridge loan will allow you to pull equity out of your current home that you're going to sell and then use that equity to buy another house. But when you're qualifying for that other home, a lot of times people think you have to like count that debt against you. So you have two mortgages. That is not the case with a true bridge loan. So in this case, you would qualify for the new mortgage. This loan over here, you don't have any payments on that for 12 months. So that's a true bridge loan. Pulling money out of here, buying a new home, not counting this other mortgage as debt, not having any payments. You can take your time. You can rehab that loan, that home if you needed to do some TLC, and you could buy the other one with a lot less stress, and then take your time on selling that other property. Now, mind you, you have to have equity in that property for it to work, but that is the definition of a bridge loan. So here's how it works. I mean, I already kind of went over it in detail, but a bridge loan allows the borrower to make an offer to buy another property without having his departing property under contract. So literally, you don't need to have the home under contract at all. There's no contingencies, guys. You can now make an offer with no contingencies. So you can have a home, have a mortgage, pull the cash out, make an offer, and you will not have a contingency to sell when you're making that offer. That's the biggest piece of the bridge loan. It's going to pay off, the bridge loan is going to pay off the old mortgage. So there's no payment with that anymore. The new bridge loan is going to be the new lien, and that's going to give you the money. So if they owed $400,000, you need $200,000 to the new purchase. So you increase that loan. The bridge loan is going to be $600,000 on the departing loan. That'll give you $200,000 cash to put towards the new purchase. And again, there's no monthly payments on a bridge loan on the departing property. That's the biggest key to this. Now, they don't come cheap. There are some caveats to it that are very beneficial. So I think the benefits of this program far outweigh the cost of the program, but let's go over it. You don't count the payment. We already talked about that. That is huge because a lot of people cannot afford covering both of those payments when they're buying another one. And we can go over a mini bridge in a little bit, which does count that. But you can buy the home with no contingency. You can use the equity from your current home and it take up to 12 months to sell that departing home. And remember, no payments on it while you're selling it. And because you have up to 12 months to sell, there's a lot of time for remodeling. And how many times have you seen people buy a home over the last 12 months or 16 or 18 months? Hold on. Excuse me. Sorry about that. Where they bought a home, they went under contract, and for some reason their house didn't sell in time, so they had to cancel the contract. I mean, there's nothing worse than that. This is a solution for that. So no longer will there be any canceled contracts because of contingencies. You can use this in exchange for that. No offers denied because of a contingency. So those borrowers where you're talking to them, they have a property to sell, they need the money from that, but they just, right now in the markets, people are not accepting offers with contingencies. This is your solution. It'll also eliminate a lot of stress for those out-of-state buyers. If they're selling a house in California, moving to Arizona, you can have a lot of time to be able to manage that sale later. Don't worry about it. Come on over, get your new home, and then take your time selling that house. And they're not inclined to do any price reductions to sell it quickly because they've got time on their side. There's no need to rush. They can have that house on the sideline, sell it in their time, and not have to force it on the market at a low price just to get rid of it like a fire sale. No need to do that. And this is also a really great way to market to your sellers. If you have any sellers that say, you know what, I have a home here, I just don't want to have to sell this one and buy, too much trouble. We can do this all up front. We can front load the whole pre-approval, get everything dialed in on the bridge loan, and before they even list their home for sale, so they know everything's dialed in, and then they can go happily find their home with no contingencies. So benefits of a bridge loan are pretty strong. So what are the terms? The bridge loan, meaning the loan that's on your older home that you're departing, that is an interest-only loan. There's no payments due. There's no monthly liability created for this program, meaning that mortgage, let's just say it's $5,000 a month, you don't have to make those payments. So that doesn't affect your debt to income ratio when you're qualifying for the new home. It is a 12-month balloon. So you do have a full year to pay it, but you have to either sell the home before that or refinance that loan before that 12 months comes up. We can finance up to 75% of the value of that home that you're departing. So if it's $1 million home, that's a $750,000 mortgage we can get on that. So if you owed $500,000, that $750,000 would give you $250,000 towards the new purchase. There are some points on that. So it's not a cheap loan. It's very similar to, I mean, there's a lot of risk involved with this loan, but it's worth every penny. The new loan that you're getting on the new purchase has to be 80% or lower loan to value. And the rates that start on the bridge loans are at 7.99. So this is a very unique product. The rates don't fluctuate very much. But that bridge loan that you're leaving behind is 7.99. Now that's not much higher than where rates are at right now, which is shocking to say, but it's not much higher than where rates are right now on a traditional mortgage.
Is it a fixed rate for that 12 months or is it variable?
That is a fixed rate 1-year balloon. Good question. And then the flexible guidelines on this, here's where it really comes in to be creative, because it's not a traditional conventional loan. It is a non-QM loan. So full doc works, asset depletion loans work, which is basically if you're a retiree and you've got $4 million in stock, but you don't have any income, you can use that asset that you have, and there's a calculator we use to calculate how much income we can just give you, kind of like a stated income loan. We give you income based on the assets you have. So in this circumstance, $4.5 million, you may get $25,000 a month in income that we can give you in that formula and use that to qualify. Also bank statement loans and a combination of any of these we can use to help you qualify for this transaction. And the pre-approvals these are very extensive. Because there's so many moving parts, we don't want to just go in there with a basic pre-qual and say, yeah, we've got a bridge loan, and then just hope it works. We need everything from the borrowers. We need to dial in everything because there's too many moving parts to risk hoping that everything the borrowers told us was true. Because we all know buyers are, who's going to say it first? Yes, buyers are liars. So they don't mean to do it. They just don't know all of the reality behind what it takes. I mean, think about it for this. Every type of loan that a borrower gets, they go in to get a car, they go into the credit card, they fill something out that says, what's your income? They're like, oh, the highest I've ever made is 150,000. So they just put that. And they get the loan, they get the car, they get the credit card, and everything's fine. They don't re-verify. This is the only debt where consumers that have been trained on just putting in what their income, what they think their income is, this is the only one that's ever verified and validated. So a lot of times people go online and they put it in, and you end up getting their pay stubs and like, what were you smoking? This is so different. And they're like, well, that's what I made last year. And they might not even have that job anymore. So getting a proper pre-qualification is imperative to a good transaction. So what is the mini bridge? So we talked about the real bridge loan. What is the mini bridge? And this is something that I've been doing for a while. And it's cheap, it's very inexpensive, but you need to qualify for both mortgages on it. So basically what it is, it's a home equity line that we get on their departing residents. So let's give an example. So let's just say somebody has a home, they bought it like 10 years ago, they owe $200,000 on it, but it's worth $750,000. We can get a home equity line on that, and for a couple $100,000, and use that as the down payment. The difference is That home equity line is free, doesn't cost anything. There's no points associated with it. But here's the big difference. You have to qualify with all of the mortgages when buying the new one. So if they're really well qualified, they may be able to do it this way. It's the mini bridge. It's the cheap version, but you have to qualify for the original mortgage, the home equity line, and the terms for the new mortgage. You have to be able to cover all of those payments. Now, a lot of people can do this. You'd be surprised. A lot of people can do this, but it's important. It's very, very important that we talk about this during the listing, because you can't get a home equity line of credit on a listed property. So if you have a customer that's going to be listing their home in the future and you're trying to plan now, have them get a home equity line immediately before that home is listed, because then it's still a primary residence. It's not listed. Lenders don't like to do homes on properties that are going to be listed because they're not going to make any money on them. That's why there's points associated with a bridge loan. They know there's not a long-term play on this where they're going to make money on it. So a home equity line before it's listed can act as that bridge, the mini bridge. It's cheaper, but you have to qualify for all of those payments on all of the mortgages in order to buy that new house. So that's the biggest difference. And that, again, full doc only for the mini bridge. So here's my YouTube channel. We'll open up for questions in just a second, but if you want to go to my YouTube channel, it's at Mortgage Updates in YouTube. And I urge people to jump in and watch all my videos. I've got mortgage tips, loan programs, why my team. We have the home buyer seminar videos. We have all of the Monday morning update videos I've ever done are in here. So if you ever want to go scroll through them and check it out, you can always do that. And also don't forget about monthlyhomebuyerwebinar.com. First Friday of every month. It's coming up soon for the next homebuyer webinar. So you can send your borrowers that way. It's live, it's interactive, and it's a lot of fun. So if you have anyone that's wants to learn the process, you can have them jump onto my monthly homebuyer webinar the first Friday of every month at noon. So you've got to have questions. This is a pretty big topic, these bridge loans. So I want to open it up to any Q&A that you may have, because it is unique and you can use it a tremendous amount of ways. So
Hey, Sean, I have a question. Can both of these products work whether the primary resident or current residence has a mortgage or not? If it's free and clear, can both of these still work?
Yes, absolutely. So the new debt would just take the place of the other mortgage, or that new home equity line will go into first position.
Okay.
As the oldest on the property. So yes, that's a good question.
And in the case of the true bridge loan, where there is a mortgage, are you paying off that first mortgage when you put the bridge in? Okay, so if they're in the $1 million example where they owe $250 and they're borrowing or bridging to $750, the points are on $750, not on the $500 difference.
That is exactly correct. Yeah, so it's a pretty expensive, but think about it this way. So if they're going to be, go ahead.
I get that, but so since you're paying off the $250 and replacing it with a $750, their mortgage payment goes away entirely.
Yes,
because there's no payment. Okay.
So they have a new mortgage. That new $750,000 bridge loan is deleting.
No payment. No payment on that.
The other one. So they have that, and that loan does not have any payments until it's sold.
Okay. And the new house that they're buying, if they're downsizing, for example, and they're just buying a $500,000 property, so basically they'd end up with no mortgage after.
Yep, they could buy that one with.
But they have to hold it. They just have to hold the mortgage for a year, and then they can pay it off.
That's correct.
Okay, got it.
Yep, that's correct. Yep. So good question. Yeah, if you look at the cost, and I kind of broke down a few different scenarios in my head. I've seen where customers are pre-qualified contingent on the sale of their home, and they're into their purchase 15 days and they still don't have an offer. Maybe it's a 45 or a 60-day close. They still don't have an offer on the house. So they're rapidly discounting their listing to the point where it finally sells, and they may lose 3 to 4% on that sale because of the drops that they've had to do, and just the stress and there's the frustration. So yes, it's an expensive mortgage, but it's a means to an end to really create a really special process to do it in a very stress-free environment. It's not for everyone. That's why we have the mini bridge, but it's a great product.
Sean, I have a quick question, and I had to take a call, so if I missed you talking about this, I apologize.
No problem.
I understand how the interest is figured into this. So it's 7.99% interest. How is that calculated, and what is the actual cost at the end of the loan for that?
Got it. So it depends on how long they hold the house, but the payments are rolled into the actual loan. Every month that goes by, it's 7.99 interest only. That interest is then calculated and it's added to the balance as you go. So
Okay, so
it'd
it's
be better
monthly.
off for them to pay it off quickly so
Okay.
that they don't have as much added to that balance of their mortgage. But that's how it is calculated. It's simple interest. So just do 7.99 times 500,000 divided by 12. That's your payment. That's what's going to be added to the loan balance as you go.
Thank you.
Yeah, good question. So I was thinking about ways you can market this. If there's any cancellations of listings, or if there's any listings that are on the market for a long time, you can call those canceled listings, say, hey, you canceled your listing. Was there a reason? Are you trying to buy? Like, what's your story? And try to get your foot in the door utilizing this bridge loan as a way to potentially let them buy before they sell. It's just another tool to add to your quiver of arrows, so to speak, in your bag. Any other questions? I couldn't have been that good at answering and making this presentation. There's got to be more questions. Well, if you guys have questions, I'm always here. You can always call me, text me, email me. But I think even if they don't do the full bridge loan, it's a way for at least you to have more knowledge and more opportunity to help your borrowers. It's not a loan that's used very often, but there are special circumstances that would really use this, and I want to make sure you're aware of those.
I have one more quick question, Sean. Can you
Sure.
please send out that the PowerPoint slide that you had with the bullet points on it?
Absolutely.
Thank you.
Yeah, and this is recorded too, so I'll send you the recording as well.
Thank you.
Absolutely.
Thanks.
You're very welcome. I'll stay on the line for a little bit longer. Say a little prayer for rates. Let's tell these banks and these FDIC and everyone else to slow their roll on selling off these mortgage-backed securities and treasuries. Because if they weren't doing that, rates would be much better right now. All right, guys. Well, happy Monday. Enjoy your week. And I'll hang out here for a little while if you have any further questions. And you guys have a wonderful week.
Hey, Sean, it's Sarah.
Hey, Sarah, how are you?
Good, thank you. That was really great.
Thank
That
you.
was awesome. Thank you for the invite last night.
Oh, you're very welcome. You're very welcome. And hopefully that it'll help you in the future if you ever run across this scenario.
Well, I actually have this scenario
Oh,
already.
you do? Nice.
Yeah. So I'm trying to figure out now, like, how to, like the wordings to like call this guy up and say like, this is like, seems like it's a new product.
It's not a new product, but it's coming back. Let's just say that it's a new product for us. It was an older product that was used years ago that every once in a while you'll hear of somebody offering a bridge loan. Now we have it, so they're rare.
Oh, okay. Okay, because I tried to get him a bridge loan before, and first I think he ended up having to use Wells Fargo or something, and for some reason it didn't work out, and I don't know the details behind it all. But
most bridge loans don't allow you to ignore the payment on the bridge loan.
Yeah, okay.
That's
So that's
a big deal.
Yeah, this is a big deal. That's why I'm like, I stayed on to talk to you.
Yeah.
So okay, what he has is he has two properties. And they both have mortgages on them, but there's still equity. There's also equity in them. So what he wanted to do was he wanted me to sell both properties and then purchase another property. And it's
Okay.
difficult, has been difficult to do all of that.
Yeah. No,
Yeah,
absolutely. I can see how that would be. So
Yeah,
2 properties to sell, I'm taking notes,
yeah.
and then 1 to buy.
And then one to buy with, so he wants to like, so he wanted me to start with one property first. And so it's, I'll just tell you where it is. It's down in Niwot.
Okay.
Are you familiar with that area?
Not super, but
Like by Boulder.
yeah.
Yeah. And
Okay.
then, so it's an Italian villa.
Okay.
So last time I looked, it was like, I'll just like say like, I'm just gonna say around 3 million, you know what I mean? But I have to
Yeah.
like just do all my comps and all that stuff. And then there's another property in Cordillera, and let's just say that for argument's sake, the same price, you know what I mean? Just to keep numbers easy for now. And then I can, if this is theoretical at this stage. And so he wanted me to sell the Niwot first, then the Cordillera, and then, but in the same time, be looking for a property in Cordillera.
Okay. Now, what was the purchase price on the one he wants to buy?
Well, that's changed since, because in August was when he wanted to sell, in August was when we put an offer on a place, and it was 4.5. But now those houses don't exist for that price, probably went up by 1 million since then.
Oh, wow.
Yeah. So
Okay.
let's just like around that price. So around that,
Now, what occupancy would this property be?
well, that would be number one.
Would it's his primary home that he's gonna be buying?
Yes, uh-huh.
And the other 2 homes, are those rentals, or was one a primary right now?
No, both primary. They use them both back and forth because one is down in Denver and then one is up here. So they
Okay.
for.
Are any of them rented currently, like on VRBO, advertised on VRBO or anything?
No, they don't rent them.
I know some people like to, while they're not there, put it on for rent. Okay, perfect. All right, well, let
Is
me,
that better? Is that better for them or worse for
No.
them?
it just changes a little bit of how we structure things.
Okay, but yeah, no, I'll double check, but I'm like 99.999% sure they don't rent their properties out.
Okay. All right, perfect. All right. I mean, this is something we can absolutely explore. I'm not sure about doing 2 properties against one, if we have to cross collateralize that. Do you know how much they owe on the properties?
Well, yes, so I did have the numbers before. So like I would just say like I don't have my notes in front of me, but the something like 1.5 on each of them, something
Okay.
like that. Something like that.
Okay.
Because one he purchased in one Niwot he purchased in I think 2012. And then, just tells you how much he paid on the mortgage, you know what I mean? How much equity he's able to build up and then the appreciation, right?
Yeah, yeah.
And then
There should be 750,000 in each home then. Okay.
I'm thinking like, so then he wanted to use that as towards the, payment, the down payment and of the primary home then, like just the one,
Yeah. Okay.
So I guess I'm just kind of thinking like, how would that look like? How much does it cost? So he works for this international company. And now I guess maybe their head office just moved to Denver. I'll have to double check. Or maybe he's just working out of Denver now. I'm not sure. But either way,
Okay.
he's got this so yeah. So he deals with Wells Fargo and all that stuff. So I'm just trying to figure out like a way to like introduce you to him because I feel like there could be some value in him learning about this and then understanding how it could possibly apply for them in the future when they're ready.
Yeah, I mean, we could just do a conference call with all 3 of us and say, hey, I have somebody that has a unique bridge loan and if you have any questions, you can just pick my brain.
Yeah.
Feels comfortable, then we can move forward with really getting the details.
Well, you know what? Yeah, that's what I'll do is like, I think he's I would feel more comfortable not being on the finance call, but like introducing you guys. So
Yeah.
I'll
just a
think
quick
about,
intro.
I'll think about all of this and see like how I could figure out like how I could introduce him to you, because I feel like there's a lot would be some value. Like what, like I know he is also very money conscious. Like, so you know what I mean? Like,
Yeah.
so like what, like something really expensive may not be like ideal for him, but I don't, if we could, I would be curious to know some scenarios of the how much it would cost him to look at the, and if he can apply for the mini bridge and then the
Yeah.
true bridge. So both scenario, can you do both scenarios and show us the cost? I think starting with an email maybe.
Sure.
Would that work? So that way that we can open up the conversation saying, we could say like, if you can, okay, I'm just brainstorming right now, but like we start with an email. But I guess I would need to update his scenario. So I should ask him about a scenario and then I'll get him to get you to send his customized scenario to him, and then you guys can talk from there.
Okay, that works. And
Yeah.
yeah, there's gonna be a big difference between the two. Obviously, income and verifying the income on that is gonna be critical to know
Yeah.
what he can do. But
Yeah.
I'm happy to go over those because he may not be interested at all in the full bridge loan,
Mhm.
but he might be really interested in the other one. So let's present both and
Yeah. Yeah.
take it from there.
Yeah, exactly. So, and I'll just see like what, because they were wanting to do this last summer but now I don't know, like there's a couple of things that happened, like along with the interest rates and stuff. So I'm like just kind of reconnecting with them now to see like where they're at with everything, and maybe they're like not interested in moving forward at all whatsoever. But you
Sure.
said it's important to do this all in advance before listing because
Yes.
so that's
Yeah.
why I'm reaching out to you because of that reason.
Yeah, because if you sell a home and go into contract and you're trying to do bridge loan, it doesn't work out and you're stuck with the sale and now you don't have a house, that could be a problem.
Well, so this is what they're all afraid of, I think, all
Yeah.
those things.
Yeah,
Yeah.
that's where we do everything is front loaded. Everything's done up front and it's dialed in, and then you move forward with the process.
Yeah.
Yeah.
Okay. This is really valuable to explain. Or I need to just digest it, think about how to say it, and then
Sure.
reach out to them and then see how I can connect you guys.
You got it.
Well,
I look forward to
so-
hearing from you.
Thank you for taking the time for doing this, and I'll be reaching out. Thanks,
You guys,
Sean.
Sarah. Enjoy your day.
You too. Bye.
I see it.